So if you've ever looked at your investments during a market crash and felt that sick stomach dropping urge just to pull everything out and dump it in cash, this video is for you. Because that feeling, it's not weakness, it's not you being bad with money, that's your brain doing exactly what it was wired to do. And if your investments aren't built to survive that moment before it arrives, it will cost you more than you can imagine. So today, I want to talk about one of the most overlooked concepts in investing, and certainly overlooked concepts in investment content online: the attack defense split. Now look, it's not glamorous, it won't go viral, but it is without question one of the single biggest factors that separates investors who actually build wealth from those who kind of just almost did. There's 4 things to cover, so let's get into it. Now, before we can talk about what to actually do with your portfolio, you need to understand the one thing that kills more long-term wealth than bad stock picks and bad timing or bad luck combined. Because if you miss this, nothing else that I'll say in this video today actually matters. So, research from a firm called Dalbar publishes an annual study comparing what real investors actually receive and get from their investments versus the fund or market returns that they're supposed to get. And year after year, the gap is absolutely enormous. The average investor dramatically underperforms the very funds that they're intending to invest into already are. Not because the funds are bad, but because they buy when things are going well and sell when things get scary. It's just classic. There's a behavioral concept behind all of this called loss aversion. This was proven by Nobel Prize winning research many years ago. The psychological pain of losing money is roughly twice as powerful as the pleasure of gaining the same amount. So losing £10,000 feels twice as bad as gaining £10,000 feels good, if that makes sense. That asymmetry is why market crashes feel absolutely unsurvivable when you're in it, even if it is temporary. The single greatest driver of long-term investment success, it's not picking the right company stock, it's not picking the best fund, it's not timing the market, it is simply this: staying invested long enough for compounding to do its job. That is it. That's all it is. You've just got to be in a solution that means that you can stick with it and stay in it. And almost nobody does that. Look, the reality here is that the market doesn't destroy wealth, okay? Panic does. That's the key thing to bear in mind. So here's where the framework gets real. Because I don't want to just tell you that attack and defense exists. I want to show you what exactly these two asset classes have done actually historically in hard numbers. Because once you see the trade-off clearly and you can see what that looks like, the whole thing clicks. So attack is equities generally. So this is the stock market, owning shares in companies across the global market. A global equity index fund has delivered a compound annual return of roughly 8, 9 or 10% over the last 30 years, depending on what day you measure it. This is why equities, the stock market, is the asset class that actually builds real wealth over time. It's undeniable. But here is what that return costs you. The maximum drawdown, which is basically you can just think of as like the biggest drop. So if you put £1 in at the top, whatever it dropped to, ever recorded with a global equity index was around 57% during the global financial crisis in 2008. So that means that if you had £100,000 invested at the top peak before the financial crisis, you watched your investments drop to £43,000 on paper. And the reality is that's not even a necessarily freak individual one-off event. Equity investors, and I say this to anyone who gets involved with the stock market, equity investors, you should expect drawdowns of 30 to 50% at some point during your investing lifetime. That is just the price of admission that you pay for equities and the longer term growth returns that come from equities. It is not to be underestimated. Far too many people, investing's been easy over the last, since the financial crisis, the last 15 years or so. Investing's been very easy. And I think there's a lot of people who are investing in global equity funds or purely in attack that if we have a real crash, are going to come really, really unstuck. Defense is the other side of that coin. It is things like bonds and cash. So a global aggregate bond fund, which is just the same thing as a global index fund, so a collection of everything, but instead of being the stock market, it's for bonds, has historically returned somewhere between 3, 4, 5% a year. Now, straight away, you can see the trade-off. Obviously, you're thinking to yourself, well, that's rubbish. That's not as good as the stock market. You're giving up a meaningful chunk of return compared to equities, right? But look what you get in exchange. The maximum drawdown on a global bond index, for example, has historically been around 15, 20% at its worst. So instead of watching your portfolio or investments go down by at least half, which it would in the stock market, you're absorbing a much more sort of shallower and more manageable dip. Now, that's the entire framework with two numbers, right? Higher return, much higher volatility. Lower return, significantly smoother ride. Neither is better or worse in isolation. They just are what they are. Everything in investing is pretty much just a trade-off between volatility and growth. That's the trade-off. Your job is to find the right point on the spectrum for you, because it's not right for everybody. People have this assumption that investing your money or making your money work a little bit harder means that you've got to go from cash, which is, okay, in the short term, zero risk whatsoever, all the way through to the stock market. That would be like cash would be a 1 and the stock market would be a 10. So there's a lot of things that you can put your money into on the way there. And of course, the attack defense helps you figure that all out. The best portfolio, it isn't the one with the highest return. It's the one that you can actually hold forever. Here's where most people go wrong, okay, like we've just touched on. They might understand risk tolerance and things like that in theory. But what people often end up doing is they assess their risk tolerance at exactly the wrong moment. Because the version of you thinking about investing when markets are calm and everything's going up and it's all going well, and the version of you that's watching your portfolio drop by 35%, let me tell you, they are very, very, very different people. Your portfolio, your investments need to be built for the second one, because that is more realistic. Look, think of it almost like packing for a holiday, right? You're in the comfort of your living room and your bedroom, you pack light and you're optimistic about the weather and it says it's all going to be sunny and that's great. And you're confident that you don't need that extra jumper. And then you land somewhere and it's unexpectedly cold and miserable, and you sort of desperately wish you'd planned for the conditions that you're going to actually face. Investing in a bull market when everything is going up, which is what most people probably watching this have actually experienced, and investing through a proper crash. Okay, we've had COVID, we had 2022, but a proper crash, those two are entirely different experiences. You need to pack for both, okay? Now, there are 4 things that you genuinely need to assess, not theoretically, but honestly. If you want great outcomes, this is going to give you the results. Firstly is your objective, okay? Give every pound a job. What is this money actually for? Is it for retirement in 30 years? Is it to buy a house with in 7? The further away and the more flexible your goal, the more attack you can generally carry. because you obviously have more time and flexibility to recover from big drawdowns. So for example, think like your pension funds might want to carry more in attack. The next one, your time horizon. As I just said, the longer your runway, the more short-term volatility you can absorb. So it doesn't really matter, does it? A 25-year-old investing for retirement has a fundamentally different equation than a 55-year-old doing the same, because they're closer to that time horizon. Your financial capacity for loss. This is really important. If your portfolio dropped by 35% tomorrow, what would it sort of materially damage your life? Would you be able to live in a 35% less good way? Would you be forced to access that money? If the answer is yes, you actually cannot afford an aggressive allocation to attack, regardless of what you think you might be able to handle. So capacity for loss is not the same as attitude. You got to think about, what would that actually mean as an impactful way for my life? If you lost 50% of your pension funds just before you're about to use it or buy an annuity, that would completely change your life. So regardless of what you think you can handle, you need to think about your capacity for loss. Then you've got your real attitude towards risk, your approach, your vibe, who you are. This is the one that people get consistently wrong. They measure it, like I said, when markets are calm, when they've looked at lovely, beautiful charts that have just gone up, that everyone's telling you the stock market is the best way to invest. But what did you actually do the last time your portfolio dropped by 20%? What did you feel like doing? What were you actually going to do before you might have second guessed it? The honest answer is your real risk profile. Look, your risk tolerance isn't just what you say in a calm room. It's what you actually do in a crisis that matters. So, we have covered the what and the why. Let's have a look at the how. Because understanding the framework is one thing, right? Actually building it in a way that works in the real world that you're going to stick to, that isn't one that's going to quietly drift off track. That's an entirely different conversation. So let's break it down. Step one, you need to figure out your split. Okay, so before you invest a single pound, you need to know what attack or defense ratio is quite right for you. I've actually put together a pretty handy, I think, risk profile tool. The link to it is in the description below. I'll flash up a screenshot of it now so you can see what I'm referring to. Honestly, go and do that first. It takes a few minutes and it's the absolute foundation of everything else. Whenever we speak to a client, whenever we put a plan in place, this understanding of this risk profile is the fundamental basis of everything. And it's massively overlooked by every other investing video that I see on this platform. It is the best and most impactful 15 minutes you will ever spend. Forget researching funds, forget doing all of that. This is what you need to spend your time on. Step two, choosing your building blocks. Okay, so look, for the attack side, a global equity fund is one of the most sensible, low-cost ways to get broad market exposure to the greatest asset class that we have, equities, right? Stocks and shares. So that's a great way to do that. For defense, you've got two kind of options, really. You can either leave that proportion in cash, or you could opt for some bonds. So some people will say, oh, if I'm going to have defense, I want true defense, I'll leave it in cash. Some people want the potential of potential growth, so they'll go for a bond fund. That gives, if you go for a global aggregate bond fund, that will give you a proper fixed income diversification. That, generally speaking, has very relatively low correlation to equities. So when the stock market goes down, bonds will tend to, not always, go up. So, for example, let's say that your risk profile tells that you might want an 80-20 split, something like that. What you could do is put 80% into a global equity index fund and 20% into a global bond fund on a platform like Trading 212. And do you know what? That would work. I'd be very happy with that. If you walked up to me with a phone that said, look, here's my portfolio. I'm an 80% attack investor. Here's my portfolio. I would say, do you know what? You are going to get 95% of the returns, the right risk appropriate returns for you. But here's the problem. And honestly, you might not think it, but I see it all the time. And it is one of the most predictable human behaviors that I've seen. So let's say you did that, right? You've got your 80-20 split. When equity markets perform well, which they do for extended periods of time, that original 80%, what does it do? Well, it becomes 85, then 90. What that means is the equity proportion outgrows the rest of your portfolio and the weighting of it becomes greater in your portfolio. So suddenly, after a couple of years, you're sitting at a risk level significantly higher than the one that you, your very self, decided was right for you. Now, in order to fix that, you can probably already tell, what you need to do is sell that 10% of the equity, sell that bit of the equities, and top up the defense sector to get back to that 80-20. So that is an active decision. Now, most people just won't do that, right? Life gets in the way. Markets are going up. Everything is great. And selling your winners, your winning bit, just feels completely wrong. And the whole carefully considered plan quietly drifts into something much more aggressive than intended. You came out. You are an 80-20 investor, not a 90-10. If you were, the risk profile would have told you that, or whatever metric you want to use to try and understand that. So this is the problem that I see. You can start off like that, you get the portfolio drift, and people are hesitant to do all of the rebalancing that's required, which leads me to step number 3. Use a multi-asset fund. Now, for most people, for you watching this right now, there is a simple, more robust solution called a multi-asset fund. Okay, so rather than having 2 funds, one in equities, one in bonds or cash, these are one fund solutions. So these funds hold a predefined split between attack and the defense, and they rebalance them automatically. You don't have to think about it. You just put your money in, and you always know that whatever level of attack and defense, they're always going to keep that in there for you. The fund just does it automatically. Now, you've probably seen this before, but the first port of call for me for sort of say, well, where would you kind of put your money, would probably end up being something like the Vanguard Life Strategy range. They run a series of funds, I think it's 5 funds that run all the way from 20% equities all the way up to 100% equities. So again, that is 20% attack versus 100% attack. So, in your pension, you might want something like 100% attack because you've got 35 years until you get there. If it's something that you need the money in a couple of years, that's when that lower percentage of attack is really, really great. Whatever split your risk profile kind of gives you, that's the fund that kind of matches it, right? That's how I've built it. So you invest and you know the balance is always going to be maintained exactly as intended. None of this drift and rebalancing and manual intervention. You can just get on with it, put your money in and focus on other things. So for 90% of investors, the right Vanguard Life Strategy Fund or any other multi-asset fund that does the job is going to give you basically everything you need. Genuinely. Low cost, properly diversified, automatically rebalanced, job done. There are loads of multi-asset funds out there. It's not a recommendation, but Vanguard, we've all heard of them. It's one of the most common. It's one of the most used. And to be honest with you, that is for a very, 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 very good reason. So for one step further, for those that are ready, if you're already past the kind of beginner stage, you're familiar with index funds, you maybe want to go a little bit further, I run a community called the Beyond the Market, where I share live updates on the portfolios that I manage for my high net worth clients. It's based on all the funds that I manage for them, and it's the same risk allocated grade. Based on past performance alone, it's outperformed the Vanguard Life Strategy range and the Global Equity Index since December 17 is when we first started using it. But that's not for everyone. I'd rather you got the foundations first with the Vanguard stuff and whatever that might well be. Look, links to the risk profiling tool and Beyond the Market are in the description below if you want to check that out. Remember, look, the best investment system is the one that you kind of never have to get in the way and override. Okay, that's what I want to leave you with. Now, if you're sitting there wondering about your own investments and how they're doing or what you could improve, I recently asked my viewers to submit their portfolios to be roasted. It was a fun video, but I think it really showed a few important lessons. So you can watch it here. The whole attack versus defense split aspect is completely overlooked in most of these portfolios, but that's certainly not their only issue. So give it a watch and I will see you there.